Brent crude just dropped from $112 a barrel to under $99 in a matter of days. Wall Street is calling it the end of the world's most dangerous diplomatic standoff. Trump stood in front of the cameras on May 24th and told the world a US-Iran deal is 95% complete and in the final stages. We've heard that before, haven't we? The S&P 500 closed at 74.73 on Friday, locking in its 8th consecutive week of gains. That's the longest winning streak since 2023. But there's a massive physical infrastructure reality the paper market is completely ignoring right now. Even if the ink's dry on a peace deal tomorrow morning, the numbers obviously don't add up. Not by a long shot. The head of ADNOC, great name, isn't it, just said, and I'm quoting here, even if this conflict ends tomorrow, full oil flows will not return before the first or even second quarter of 2027. That's the part nobody on financial TV wants to spell out. The relief rally is being priced on a physical impossibility. Today I'll walk you through the paper market illusion, the infrastructure reality nobody is pricing in, the IEA's red zone warning landing in July, and where this whole mess sits within the 18-year cycle. So hit the like button and subscribe to the channel. And if you want the full framework on the 18-year cycle, the free 3-part mini course, there's a link in the top of the video description. We'll cover the rally setup, the straight reality, the bypass maths, the World Bank emergency, and the cycle stage we're sitting in right now. So let's get straight into the data. Brent crude cash is currently trading around 95 a barrel. It hit 113 early this month before the ceasefire chatter began. Brent spot is at 99 or so per barrel. WTI is sitting at roughly 90 bucks. Meanwhile, the Dow Jones Industrial Average just printed a fresh record high nearing 51,000 points. Morgan Stanley raised its year-end S&P target to 8,000. UBS bumped to 7,900. Look at all these new targets that we're beginning to uncover from the banks now. JP Morgan modeled a path to 9,000 by the middle of 2027. Most traders are reportedly unwilling to risk missing a peace dividend rally, so they're piling in long ahead of the Memorial Day weekend. Now, here's the part that doesn't add up. Energy is the best performing sector in the S&P 500 year to date, up 21.5% as of May 23rd. If the market genuinely believed cheap oil was about to flood back into the system, energy stocks would be getting absolutely smoked, and obviously they're not. The bond market is also screaming the truth. Treasuries are being dumped. Yields are rising, and the University of Michigan Consumer Sentiment Index just printed at a record low for May 2026. And the Fed Governor Christopher Waller went on record saying the next rate move is just as likely to be a hike as a cut. So consumer sentiment hits an all-time low, the bond market is in a historic sell-off, and equities are grinding into record highs on the back of a 95% complete peace deal. I mean, I don't know who believes 95%, but let's go with it. Tell me that's a coincidence. And it gets worse, because this entire rally is being underwritten by a single physical assumption that does not survive 5 minutes of scrutiny. So let's walk through that now. The Strait of Hormuz has been effectively closed to commercial shipping since February 28th of this year. Roughly 14 million barrels per day of crude and refined products normally transit that waterway. That's about 20% of all seaborne global energy. We've heard those stats before. Current Strait traffic is sitting at approximately 5% of pre-war levels. At least 6,000 ships have been blocked from transiting since the conflict began. Saudi Aramco CEO Amin Nasser confirmed the global energy market has lost over 1 billion barrels of supply since February 28th. That's a billion barrels. The IEA has labeled this the largest energy crisis in history, surpassing that of the 1970s oil shock. So that's the hole in the supply side. Now, here's the part that breaks the entire ceasefire rally narrative. The 60-day political ceasefire does not fix a 6 to 12-month physical supply chain bottleneck. The strait is mined. We're not talking about a handful of contact mines you sweep in an afternoon. Iran deployed a huge variety of seabed mounted, tethered, and rocket propelled explosives. triggerable by sound, vibration, movement, magnetic fields. It's just absolutely disgusting. But GPS-based mine hunting systems are easily jammed in the region. The UK Royal Navy is leading a multinational coalition of approximately 40 nations to clear it. Commander Gemma Britton, who runs the Royal Navy's Mine and Threat Exploitation Group, explicitly cautioned that fully clearing the entire strait could take months or even years. It's a long time to clear out all of these mines. Now, the US Navy stated that it does not have the capacity to reopen the strait through escort services alone. That's how they know they need the coalition. And the coalition is currently in what they describe as suspended animation. Well, let's talk about that. They're really ready, but strictly awaiting a finalized peace agreement before operations can begin. So even if Trump signs his 95% complete memo today, demining doesn't start tomorrow. It starts when the lawyers sign off. Then they clear one transit lane for roughly 700 stranded ships. Then they clear a second incoming lane. Then, and only then, can the commercial insurance market actually price this as a usable waterway again. UK Armed Forces Minister Al Khan's said it plainly. Even after partial clearance, assurances are insufficient for commercial insurance firms. The industry requires verified, comprehensive clearance before resuming normal operations. Now, the bypass routes. This is where retail looks at Saudi Arabia's east-west pipeline and says, well, surely they can just route around it. The Saudi Petroline is currently running at its maximum capacity of 7 million barrels per day. The strait normally carries 14 million, double. The maths doesn't even come close. The UAE's west-east bypass pipeline is only 50% complete. Their accelerated timeline targets full completion into 2027. And Iran has now asserted regulatory jurisdiction over waters south of the UAE port, Fujairah. So they've literally extended a claim over the bypass terminal. This is the part the equity market is pricing essentially none of. Now let's have a look at who's talking about this. The International Energy Agency has issued repeated warnings that global oil markets enter what they're calling the red zone by July or August. The red zone is defined as inventories falling below minimum operating levels. That's a threshold where storage systems can no longer function efficiently, where refineries and logistics start to physically break down. They called the situation the biggest energy security threat in history, and I'm quoting him directly. Now, why is this July and August? Because three forces are converging in exactly the same window. One, peak Northern Hemisphere summer demand from travel and cooling. Two, no new Middle Eastern exports coming back online. And three, emergency reserves being burned through at a record pace. In March, the IEA's 32-member coalition executed the largest strategic reserve release in history. That's 400 million barrels released into the market. As of early May, 164 million barrels had already been pulled out, flowing at roughly 2.5 to 3 million barrels per day. Russian floating stocks were depleted by end of April. Iranian floating stocks were depleted by end of May, which are basically there now. And the IEA's emergency releases are projected to be fully exhausted by July 9th. That's 6 weeks away. Global inventories are currently drawing at a record pace estimated at 8.7 million barrels per day. Jeff Curry at Carlyle says Asia is already at tank bottoms. Europe is following. The US could face shortages by July. Now stack the forecasts. Barclays sees Brent at $100 for the full year on a structural deficit. Citi sees $120 near term. Wood Mackenzie's extended disruption scenario has Brent potentially running up to $200 a barrel. We'll see about that, but they're saying 200. And the equity market is treating a 60-day political pause like the all clear bell. Let me show you the part that almost nobody is talking about, as per usual. 27 countries have now activated emergency crisis financing mechanisms with the World Bank. Kenya, Iraq, and others have publicly confirmed seeking support. The World Bank's crisis toolkit immediate capacity is 20 to 25 billion, scalable to 60 billion within 6 months and up to 100 billion in the long term. The mechanism nations are using is called the Rapid Response Option. It lets them redirect up to 10% of undisbursed financing from existing projects to emergency needs. So the translation is, this crisis is eating directly into global development capital. The Asian Development Bank has downgraded its 2026 growth forecast for developing Asia to 4.7%. The Philippine peso, Indonesian rupiah, and Indian rupee have all hit record lows against the dollar. The World Food Programme estimates the conflict could push 45 million additional people into acute hunger by mid-year. Urea fertilizer prices ripped 46% higher month on month between February and March. That threatens 2027 crops, the crop planting across the entire planet. Kuwait is projecting a 20% contraction in real GDP this year due to nearly 50% drop in crude production. And the US consumers have already absorbed an estimated $45 billion in additional fuel costs. You hear about that on CNBC? Probably not. I don't hear about it here in Australia. The narrative on financial TV is complacent, driven, in the words of one analyst at National Taiwan University, by wishful thinking that the war ends quickly. The crisis is being framed as a temporary shock when structural experts are calling it a chronic ailment. If you want the full breakdown on how this stage 5 to stage 6 transition fits into the 18-year cycle, I've put together a free 3-part mini course. Part 1 is the cycle itself and the 220 years of data behind the cycle. Part 2 is exactly where we sit in that cycle right now, which then leads on to part 3, which is how we're positioning for what comes next in the cycle. It's absolutely free. There's a link in the top of the video description. Now, let's bring all this back into the framework. If you've been following the channel, you know we talk a lot about the 18-year cycle. The cycle runs roughly 14 years up and 4 down. The final 2 years of the boom phase is what they call the winner's curse. This is when speculation goes vertical and when credit explodes. It's where governments inject liquidity to keep the boom alive. And that's where the equity market is the very last asset class to capitulate. Every other asset class is already flashing the signals. The bond market is in historic sell-off with the Fed openly debating hikes. Oil's in a structural deficit that physically cannot resolve until first half of 2027, according to ADNOC CEO himself, and 27 sovereign nations are quietly tapping the World Bank emergency financing while equities print all-time highs. 3 independent classes of capital, 3 independent confirmation signals, all firing simultaneously. I don't think it's a coincidence when it's all coming together right on schedule within the 18-year cycle. The equity market is using a 60-day political headline as the last relief valve against the gravity of every other macro indicator on the board. Tops are a process, not a single event. This can take many, many months. We've said that on this channel for a long time now. Usually, we see the bond market peak. Then commodities come in, they start increasing, the inflation comes through. Then the equity markets peak and capitulate. In 1973, OPEC embargo is the closest historical analog we have, and the IEA itself says the current situation is worse. In 1973, alternative routes eventually absorbed the rerouted supply over the following year. But you can't really bypass Hormuz today, not at the volumes that matter. The Saudi pipeline tops out at 7 million barrels per day. The UAE line is half built, and Iran has extended its claimed jurisdiction over the bypass exit point. That is the configuration the framework has been forecasting for this exact window. Late cycle policy paralysis, a geopolitical shock arriving right at the winner's curse phase, smart money positioning for capital preservation while retail buys the relief headlines. Not to say that the stock market can't go higher, but there are signs there that there is some profit taking being had by the big money. The world's most dangerous standoff isn't ending anytime soon. It's just transitioning from a political crisis into a physical infrastructure crisis. The market's pricing a perfect resolution, and actual supply chain cannot deliver until 2027. Capital preservation in this phase is not optional. I think it's the entire game. I could be wrong, I might be overcautious about this, but again, I'd rather be prepared and wrong than unprepared and right. If you disagree, feel free to drop your call in the comment section. I'll be reading every single one of them and replying to as many as I can. So hit that like button, subscribe to the channel, and get your free copy of the 18-year cycle mini course. Link is in the top of the video description. I'll see you guys in the next video. Until then, take care and peace out.